The trade war between the United States and China has just taken a dramatic new turn, and this time, the retaliation is massive. 32 of China's most powerful companies have launched a coordinated counterstrike against American interests, hitting back at Washington's latest round of sanctions and trade restrictions. These aren't just small firms. They include major players in technology, manufacturing, and energy, industries that form the backbone of global supply chains. For years, both nations have exchanged economic blows, but never on this scale from China's corporate front. The stakes are now higher than ever, with billions of dollars in trade and millions of jobs caught in the crossfire. What happens next could redefine the balance of global power. The US-China trade war didn't erupt overnight. It was the result of years of simmering economic tensions. The roots trace back to long-standing disputes over trade imbalances, intellectual property theft, and market access. Washington has accused Beijing of unfair trade practices, including heavy subsidies to Chinese companies, and barriers preventing foreign firms from competing on equal terms in China's vast market. In 2018, under President Donald Trump, the conflict escalated sharply when the U.S. imposed billions of dollars in tariffs on Chinese goods, aiming to force Beijing into a more fair trade agreement. China retaliated with its own tariffs, targeting American agricultural products, automobiles, and industrial goods, striking at politically sensitive sectors. Over the following years, both sides engaged in a cycle of tariff hikes, sanctions, and blacklisting of major corporations. U.S. measures against Chinese tech giants like Huawei and ZTE further deepened hostilities. Meanwhile, China sought new alliances, expanded domestic manufacturing capabilities, and diversified its supply chains to reduce reliance on American imports. While temporary truces and partial trade deals were reached, neither nation fully backed down. Instead, the rivalry solidified into a long-term strategic struggle, one in which economics, technology, and national security became inseparably intertwined. The latest escalation began when Washington unveiled a sweeping package of measures aimed squarely at China's economic heavyweights. The U.S. government accused several Chinese companies of aiding in state-backed cyber activities, supplying advanced technology to sanctioned entities, and engaging in unfair competitive practices that undermined American businesses. As part of this crackdown, dozens of Chinese firms were added to the U.S. Commerce Department's entity list, severely restricting their ability to purchase critical components from American suppliers. These restrictions hit sectors such as semiconductors, telecommunications, renewable energy, and aerospace, all vital to China's long-term growth plans. Adding fuel to the fire, the U.S. also moved to freeze certain Chinese corporate assets in overseas jurisdictions and pressured allied nations to cut ties with targeted firms. The message from Washington was clear: these companies would face mounting isolation from Western markets unless they altered their practices. But in Beijing, the move was viewed not as a legitimate enforcement of fair trade, but as a political maneuver to stifle China's rise in strategic industries. The result: a call to action that united some of China's biggest corporate players in a rare show of solidarity, setting the stage for a forceful counterattack. China's response came swiftly and with remarkable coordination. Within days of Washington's announcement, 32 of the nation's most influential companies, spanning technology, manufacturing, finance, and logistics, unveiled a joint strategy to push back against the U.S. measures. The retaliation included suspending or restricting purchases from American suppliers, redirecting contracts to domestic or non-U.S. partners, and tightening export controls on rare earth elements and other critical materials that the U.S. economy relies on. Several Chinese tech firms also announced plans to block certain American software and services from their platforms, cutting into valuable U.S. market share. In addition, Chinese banks and financial institutions began reviewing their exposure to U.S. debt instruments, signaling a potential shift in investment flows that could unsettle American financial markets. What made this retaliation stand out was not just its scale, but its precision. Each move was calculated to target specific sectors where the U.S. held competitive advantages, from advanced microchips to aerospace components. Beijing framed the retaliation as both a defense of national sovereignty and a warning shot, making it clear that any attempt to economically corner China would be met with an equally forceful, well-organized counterstrike. The coordinated retaliation by 32 Chinese firms sent shockwaves through the American economy. Within days, several U.S. industries felt the sting, particularly technology, aerospace, and renewable energy sectors. that relied on Chinese-supplied components and rare earth minerals. Shortages in key materials caused delays in production lines, raising costs for manufacturers and threatening layoffs in already fragile sectors. American tech companies, once eager to tap into China's massive consumer base, faced abrupt revenue declines as Chinese partners pulled contracts and promoted domestic alternatives. The loss of market access in China not only meant immediate financial hits, but also long-term erosion of brand presence in one of the world's fastest-growing economies. Meanwhile, Wall Street reacted nervously. The hint that Chinese financial institutions might reduce U.S. debt holdings spurred volatility in bond markets and nudged interest rates upward. Investors, sensing an intensifying trade standoff, began shifting portfolios towards safer, non-dollar assets. Agriculture also suffered collateral damage as Chinese buyers postponed or canceled orders for American farm products, further squeezing rural economies. In essence, China's retaliation struck at the U.S.'s economic nerve points, proving that the world's two largest economies are locked in a high-stakes struggle where neither side can inflict pain without feeling it in return. While the retaliation demonstrated China's economic strength, it also carried risks for its own markets. Cutting off U.S. imports and services disrupted some supply chains, particularly in high-end semiconductor equipment and specialized technologies, where domestic production still lags. Certain Chinese manufacturers faced short-term slowdowns as they scrambled to secure alternative suppliers from Europe, Southeast Asia, and the Middle East. However, Beijing used this moment to double down on its self-reliance strategy. State-backed investments poured into research, domestic tech firms gained market share previously held by American brands, and partnerships with non-Western nations accelerated. Chinese stock markets reacted with mixed signals, initial drops driven by uncertainty, followed by rebounds in sectors benefiting from reduced U.S. competition. Overall, while some Chinese companies endured short-term turbulence, the move strengthened long-term strategic positioning, reinforcing Beijing's vision of insulating its economy from Western pressure. The shockwaves from this latest U.S.-China trade clash rippled far beyond their borders. Global markets opened to heightened volatility, with Asian exchanges swinging sharply in response to fears of disrupted supply chains. European stocks dipped, particularly in sectors linked to export manufacturing and advanced technology, as investors braced for potential spillover effects. Commodity markets also reacted. Prices for rare earth minerals, critical for electronics and defense industries, surged as traders anticipated tighter Chinese export controls. Meanwhile, oil prices edged higher, driven by concerns that prolonged tensions could slow global growth and disrupt shipping lanes. Emerging markets faced mixed outcomes. Some, like Vietnam and India, saw opportunities to capture redirected trade flows, while others worried about being caught in the economic crossfire. In short, the global economy was reminded once again that when the world's two largest economies lock horns, the tremors are felt everywhere. While the current standoff is already causing significant economic disruption, the danger lies in how quickly it could spiral further. If Washington responds with even harsher sanctions or bans, Beijing may double down by targeting U.S. allies, tightening control over strategic exports like rare earths, or reducing its vast holdings of U.S. Treasury bonds, moves that could jolt global financial stability. There is also the possibility of a broader technological decoupling, where both nations sever high-tech trade entirely. Such a split would not only reshape global supply chains, but could force other countries to take sides, deepening geopolitical divisions. The rhetoric from both capitals suggests neither is willing to be the first to step back, raising the risk of a prolonged economic Cold War. In a worst-case scenario, economic hostilities could bleed into diplomatic and security realms, intensifying tensions in the Asia-Pacific region and beyond. As the dust settles from this latest clash, one truth stands out: neither Washington nor Beijing is willing to show weakness. The 32-company retaliation has proven that China can coordinate its corporate power as effectively as any government action, while the U.S. has demonstrated its readiness to leverage economic tools with precision and force. Yet beneath the headlines, ordinary businesses, workers, and consumers on both sides are already feeling the strain. Prices rise, markets jitter, and global uncertainty deepens with every new move in this economic chess game. The question now is not whether the trade war will continue, but how far both nations are willing to push before the costs outweigh the benefits. In an interconnected world, there are no true winners in such a conflict, only varying degrees of loss. And if neither side steps back soon, the damage could become permanent.